Dr. Lyons. Good to have you, Gerard. Thanks so much for joining in. We just had the speaker earlier, Dr. Mark Mobius, speak about how a lot of people have divergent views about what China could do and the resultant impact on commodities and global equities as well. The last couple of days, the news flow has been more positive than what we've seen over the last couple of months, maybe. What's your sense on what we do for the next or the remainder of the calendar year?
Well, first and foremost, it's a great honour and a great pleasure to be with you this evening, and congratulations to everyone who's receiving an award. And it's a great honour to follow Dr. Mobius and answer your questions. But in answer to your question, I think one should be cautious about the West and still optimistic about the so-called emerging world in the next few months. I think it's important to understand where we've been in the last few months. At the end of last year, the markets were fearing a double-dip recession in America, a hard landing in China, and fearing a near collapse of the Eurozone. We didn't get any of those. The US data has turned out to be good. The Chinese data was quite firm at the end of last year, and the European Central Bank managed to pull us back from the brink. So the markets in the first 3 months of this year have discounted a lot of good news, and the mood is quite optimistic. But I think we're going to experience a more cautious tone, but I think it's very important to differentiate across the markets. I think the US economy is recovering, but it's only a steady, not a spectacular recovery. The US economy lacks momentum, and I think that very factor will weigh on the markets. China is cooling, not collapsing. But the Chinese data will be soft in the next few months, but at least it will avoid the hard landing. So in that respect, that might be positive for the market. But my big concern is about what's going to happen in the Eurozone. Even though the European Central Bank has done very well, and even though they've pulled the Eurozone back from the brink, I still think that we have a very difficult environment in Europe. And as a result, I think the markets will become more focused on some of the tensions in the euro area, particularly in terms of the periphery. But overall, in context, it's a very divided world, it's a very disconnected world, and it's a world full of many policy dilemmas. The divisions are very apparent. East in much better shape than the West, the core of Europe in much better shape than the periphery, big firms in America in much better shape than small firms. The disconnect is very apparent in terms of issues in India such as corruption, worries about reform agenda. The disconnect is very apparent here in Europe in terms of high rates of unemployment. And as a result, against that background, it's a very much a difficult environment for policymakers. And in India, quite clearly, there's a sort of policy dilemma, the need to make sure that policy is relaxed enough to get the economy going again, but obviously the need not to ease policy too much, lest underlying inflationary fears come back to the fore. So a very interesting, very challenging investment environment, I would suggest, in the next few months.
So Gerard, just stretching that point forward about the worst case scenario, do you think an EU breakup is still very much a possibility?
Yeah, yes. I think it's important to stress that good economics is good politics. Good politics is not always good economics. And I think the biggest challenge in the euro area is that politics has driven the agenda, which means it makes it a very difficult situation to get ourselves out of. And on the continent, there is a sort of big division between the core of Europe, led by Germany, which is in pretty good shape, exporting well, low rates of unemployment, and in particular Germany exporting well to China and many emerging economies. The big challenge is on the periphery. Greece, Portugal, Spain, Italy, and even Ireland are all in recession. And I say even Ireland because Ireland has sort of done all the things that it's been asked of from the core. It's taken all the tough medicine. But despite that, it was in recession at the end of last year. And the euro area is in recession, primarily because the problems on the periphery continue. And in essence, the periphery is in the hole and has been asked to dig deeper. Now, how do we get out of it is the big issue. A lot of the heavy lifting is being demanded of the peripheral economies. They need to try and get their debt under control. But at the same time, what we also need to see is more help being provided from the centre, from the core of Europe, to the periphery. Put it another way, if Greece had its own currency, it would have to devalue 40%. If Spain had to had its own currency, it would devalue 25%. If France had its own currency, it wouldn't have to devalue about 15%. Of course, they don't have their own currencies. Therefore, they need to make up for that loss of competitiveness in other ways by squeezing their domestic economies and becoming fitter in that respect. Now, life shows that the time to change is when things are going well. Unfortunately, in life, most people try and change when things are going badly, when you're in a difficult situation. And that's true for economies as it is for many people. And what we're seeing in Europe is economies on the periphery are trying to make the adjustment at a very difficult economic time for the whole of Europe. That means the political and economic and social pain are all coming together at the same time. And in answer to your question, I still think it's possible that Greece could leave the euro, and I still think that the problems in Spain and Portugal and even Italy will come back to the fore, maybe not necessarily in the next 3 to 6 months, but certainly in the next 12 to 24 months.
Okay, Gerard, just hold on to that thought. I'm going to invite some questions from the audience here. Does anyone have a question for Gerard? Sri?
Gerard, good morning to you. My name is Sri. I work with ET now. If you look at what's happening around the world, it's apparent that although things may not get much worse than the way they are now, it's also apparent that it's not going to get better in a hurry. So do you think we're going to be stuck in some sort of, to use a metaphor from seafaring, in the doldrums for maybe a few years?
Well, thank you for the question. In terms of being in the doldrums, I do think it's very important to differentiate between the so-called emerging economies and the Western world. The emerging economies are at a very different stage of the cycle. Growth has been pretty good given what's happened in the West. Emerging economies are not decoupled from the West. And indeed, ahead of the crisis 4 or 5 years ago, our catchphrase here at Standard Chartered was that emerging economies were not decoupled, but they were better insulated. And so it proved. Likewise now, emerging economies are not decoupled, but I think they're better diversified. Better diversified in the case of India, domestic demand quite good. In the case of China, not just domestic demand, but also trade flows between the emerging economies and other emerging economies. For instance, the BRICS meets tomorrow in India. It's interesting, a decade ago, those 5 BRICS countries had combined trade between them of $27 billion. Now it's $250 billion. So when, in answer to your question, one looks at the emerging world, I think it's important to say that the emerging economies are at a very different stage of the cycle. The domestic demand is more resilient. New trade corridors across the emerging world are being seen. So given that, I would be fundamentally positive. Emerging economies, I think, in 12 to 18 months' time might face inflationary problems coming back to the fore. So I don't think they're in the doldrums at all. But in the West, yeah, you can use the phrase doldrums, but again, it's important to differentiate. The likes of Germany is in good shape compared to Spain and Greece. Here in Britain, big companies are in good shape. Companies like Standard Chartered that do lots of business with the emerging world are in good shape. Smaller firms, though, and young people who are unemployed are not in good shape. So I think the challenge in the West, though, is that we still have to pay off the debt, shall we say. So in that respect, the lesson of Japan, and also the lesson of economies that have had financial crises in the past, is that sometimes and often it takes a long time to work that debt out of the system. And that's why the recovery in the West, even in America, will be a pretty sluggish recovery. And that's why the US Fed, the European Central Bank and the Bank of England will all have to keep interest rates low for some time. And that adds to the challenge for the likes of India, because I think in 12, 18 months' time, much of the money here in the West will be seeking a home in your country and in other emerging economies, adding to not only opportunities, but adding to challenges in terms of your asset markets being pushed up by another inflow of money from the West. So more a case of doldrums in certain parts of the West, but the emerging economies, no, I don't think they're in the doldrums, but they do face other opportunities and other challenges.
Okay, Mehboob, you have a question?
We are talking of problems in Europe. Now, US has surprised us, pleasant surprise. Europe, the problems are far from over, and most of us endorse the view which you have given over here. China's slowdown, what will ultimately happen, one doesn't know. But in your address to the questions which were asked to you, you went on using the word challenges, challenges, challenges. Now, what sort of challenges we are going to have if global liquidity continues to drive up asset prices, including equities, without fundamentals catching up, and not too much of paper being circulated. Are you trying to say that valuations are going to go through the sky and nobody can challenge it despite fundamentals lagging behind? Question number one. And question number two, a slightly related question. What is the probability you would give? What is the probability you would give to a fresh stimulus boot coming from the US?
I think the key issue here is that policymakers need to set policy to suit domestic conditions. And therefore, in the case of India, the policymakers will have to set rates dependent on how they see the combination of domestic growth and inflation. If the economy, as it has done, has lost momentum, inflationary pressures likely to ease, that would justify the Reserve Bank of India easing rates. Now, if later this year, as a consequence of what the RBI does, and as a consequence of confidence returning, growth starts to gather momentum, then in addition liquidity starts to flow into Indian markets, then inflation becomes the more focused issue, and that will justify rates going up next year. So in answer to your question, yeah, there's challenges, then there's opportunities, and I think one needs to look in terms of which market and which economy one is focusing on. Quite clearly in America, in Britain, and across Europe, interest rates will stay low because growth conditions are still fragile. The challenge in the West, though, is liquidity is abundant. Central banks are taking action to make sure the growth recovery gathers eventually momentum, and are basically trying to help the economies as the overhang of debt is worked through its system. That means that in the West, interest rates stay low, and at some stage, maybe 2 to 3 years from here, there will then be the big focus on exit strategies and on tightening. Clearly, there will therefore be some excess liquidity in the West that will seek homes across the emerging economies. But in answer to your question, the clear challenge is that policymakers need to set policy to suit their domestic agenda. That's why when one looks across the world, there are very many different focuses. I was in China the week before last. The Chinese are likely to ease reserve requirements again, and they're likely to try and boost bank lending. But they're not going to go hell for leather in terms of cutting interest rates. Across other parts of East Asia, the feeling is the interest rate cycle is near the end in terms of the easing or pause, and maybe tightening will be the case in a year's time. So really, I think the key answer to your first part of your question is looking in terms of the challenges in terms of domestic conditions. Second part, in terms of whether the Fed will do anything more, I think they will. We've read the US incredibly well here at Standard Chartered. And what I think is happening is that the markets were too pessimistic in the second half of last year, and maybe the markets have become too optimistic. I tend to stress that whichever economy one looks at, the outcome depends on the interaction between the fundamentals, policy and confidence. In India, the fundamentals are quite good. Policy cover is still pretty full. Confidence, having been hit at the end of last year, is quite resilient. In contrast, in America, the fundamentals are not so good. The policy cupboard is almost empty, and confidence is still pretty fragile. Now, the important thing about the US is that the balance of risks has changed. There are risks on the downside, but also, because of what's happened, for the first time in the last 3 years, the risks are also on the upside. If there was to be a pleasant surprise in America this year, it will be because big corporate America, whose balance sheets are in good shape, decides to go out and invest. Now, last year, the big corporate America's balance sheet was in good shape. It didn't invest. I think they should, but it seems to me from my recent visit to the States that still the policy environment post-election, particularly fears about regulation, plus maybe 1 or 2 worries about consumer spending, seems to be holding back big corporate America from going out and investing. And unless they do go out and invest, then at best we have a steady, not spectacular recovery, one that's not gathering momentum. And as one can see from Ben Bernanke's latest comments, he still worries about avoiding the downside risks. And in that respect, coming back to your question, I think it's a 2 in 3 chance that there will be further quantitative easing from the US, largely because I think Bernanke wants to rule out the downside risks and at the same time hope to give some underlying store to that confidence to try and encourage big firms, hopefully at some stage, to go out and invest. They will eventually. It'd be better if they did it sooner rather than later.